Hey, welcome back. And in today's video, we're going to talk about two of the biggest advertisers in the world, Google and Meta, and what's just been happening with them over the past couple of weeks and where they're headed in the future. We're also going to talk about whether they're at a good valuation or not, and whether I'm considering buying more. So with that, let's get right into it. Now, starting off with Google, and more specifically YouTube, they've been in the news recently for potentially making their 4K video streaming on YouTube a premium feature, as well as a few posts going viral of 10 unskippable ads before the videos. And of course, this has come with a lot of backlash because no one wants to see features that were previously free then moved to a premium platform that you would have to pay for, as well as 10 unskippable ads, which is just way too much for someone who wants to watch a 8-minute video. They don't want to have to sit through 2 minutes of ads. But it seems the reason Google is doing this is to try and monetize YouTube further because of the bandwidth costs and the ever-increasing amount of data that they have to store on their servers. The challenge of Google somehow trying to manage 30,000 new hours of content per hour uploaded to its platform is immense, and especially when those files are 4K high-definition videos, it can be a lot to manage, as well as sending those videos out for people to watch. Now, another big YouTuber, Linus Tech Tips, made a video about the technical issues that Google is facing when having to deal with these 4K large files, especially when it's a free feature. He also makes the case for why it's not such a bad idea or even wrong of Google to do. Now, he goes extremely in-depth about the real technical issues that Google has faced, and that's not what this channel is about. So if you want to learn more about that, go see his video. I'll link it in the description below. But what we're trying to find out is YouTube and Google at large a good investment? So with Google taking a dive from around $104 per share now to around $94, a lot of investors are asking, is this a good time to get in on Google? Well, the reason it's kind of taken a dive recently is because the fundamentals have weakened slightly, with them posting lower guidance for the future quarters, as well as slower top-line growth and slower YouTube growth. But they've also stated that they're attempting to be more lean and efficient by lowering headcount, not hiring as much, and canceling multiple product lines like their Pixelbook and their Stadia gaming service. And I think all of this can bode really well for Google at large, where they're really focusing and locking in on their most important product lines, being their Google Search, their YouTube platform, and their cloud computing. And I think there's long runways ahead for content creators and the YouTube platform, and a lot of businesses moving their workload to the cloud, with Google being able to take advantage of that increased market size. But an equally and sometimes even more important aspect of investing is not just the story behind the stock and where the company could go in the future, but rather what the price is now and the valuation, and what am I getting for my money when I'm buying this stock. Now, with Google stock sitting around $94 per share, they are at a market cap of around $1.2 trillion, with a price to earnings ratio of 18. Now, with the average PE ratio of the S&P 500 ranging from 13 to 15, 18 is a little bit of a premium. But paying more than a 13 to 15 PE ratio is totally fine, as long as the company is worth that much, meaning that they can grow into the future and that they have a sustainable competitive advantage in their business, which I think Google definitely does. Now, a lot of value investors seek to invest in companies with low PE ratios and neglect really important factors like what the return is on the invested capital and how well these companies are at generating value from the money that they're spending and the services that they're providing. For example, Google has a return on capital employed of around 26%, which is exceptional. Now, return on capital employed is a really interesting metric because it shows how well a company is able to allocate their capital and what return they can get on the money that they spend. There's a great quote by Charlie Munger saying that if you invest in a company that gets a return of 6% on their invested capital, then over the span of 20 to 40 years, you will likely get a return of around the same number of 6%, even if you bought it at a huge discount. He goes on to say that if you invest in a company that gets a return of 18% on their invested capital, over 20 to 30 years, even if you pay an expensive price, you'll end up with superior results. Now, all of that to say that retail investors need to look at a myriad of metrics before investing in a company, and not just look at the PE ratio, their growth rate, but rather look at how efficient they are at deploying capital. And now back to Google, we have seen their trailing 12-month revenue go from around 160 billion to over 280 billion just within the past 2 years. And that's around 75% growth just since COVID. And I think that's important to keep in mind when we're looking at how fast these companies are growing, because those are extremely tough comparables to match up against this year. And even with those elevated growth numbers, we saw Google grow this last quarter around 6%, which in my opinion is really impressive, being that you can grow over $100 billion in revenue and still manage to get a 6% return on that the next year, among rampant inflation, interest rates rising, and supply chain issues. But it's important to remember that all of these metrics are in the past. And although it was just the past couple of years, it is in no way indicative of what will happen in the future. But with some institutions believing that the digital ad space will grow from 13%, 11%, and 8% respectively within the next 3 years, I think Google will continue to grow their revenue and market share within the digital ad space, alongside the likes of Apple, Meta, and Amazon. Another great driver for growth in the future for Google is that their cloud service is growing at 35% year over year. And although it's not profitable yet, they are showing great progress in the right direction and prioritizing growth in the earlier years to generate massive profits in the future. Now, with all of that being said, I don't think we'll see the same growth in Google we saw the past 10 years, but I could be wrong about that. They're investing massively into AI to make their ads more effective, expanding their product line of Pixel devices with their phones, earbuds, watch, and many more devices, as well as exciting new leaps in quantum computing and AR glasses, and many more projects that could reignite the growth for this company in the future. So with this recent drop in price, I think it could just be the market being short-sighted with Google, and it could be a great opportunity to get in at a low price. And as for myself, I bought more Google this week, and it now makes up around 16% of my growth portfolio, which is heavily concentrated, and I wouldn't recommend that you do this as well. But for my personal situation and goals for my portfolio, I think that it's appropriate. Now, moving on to Meta, we saw an even more dramatic drop in share price of over 25%, losing more than $60 billion in market cap. Meta currently sits around $92 per share with a $246 billion market cap and a PE ratio of 8.7. And when you're looking at PE, Meta sits with the likes of Intel and AT&T, despite having a far better return on capital employed of 22.8% over the past trailing 12 months. Now, one of the major reasons that Meta is dropping is because when you're buying Meta stock right now, you're investing in a dominant ad business that is supporting a huge aggressive investment into the metaverse. And if you don't believe that VR and AR devices will be the future, then you should probably not touch this stock with a 12-foot pole. But if you think VR and AR technology is going to be a big part of the future, then you may want to consider Meta right now, because they are investing heavily into that ecosystem and trying to build out something special at Meta. It's important to note, though, that there's a lot of conflicting opinions about whether this metaverse spending will create returns for the shareholder and position Meta in a good place to take advantage of this new metaverse. There's also been a lot of notable investors that have came out and said that it's important to keep in mind that dollar spend in the past has not always created these new products, with the Apple iPhone only taking a couple $2 billion to create, despite being the most popular consumer product of all time. It's important to keep in mind where we are within the adoption curve of these AR and VR devices, because as of right now, Meta is the only bigger company to really have out a product besides other players in other countries. I do think it'll be really interesting to see what other companies like Apple, Microsoft, and possibly Google have to offer. And then it'll be a lot easier to stack Meta up against their competition. But until then, all we really have is a money-burning furnace that's sucking up all the profits from their advertising business. Although there's big question marks around everything surrounding the metaverse, I do think Meta is doing a good job at creating partnerships like the one with Microsoft, where they're having Microsoft Excel, Word, PowerPoint, and Microsoft Teams all within Meta's platform, furthering their productivity suite, which I think will be really important if they want professionals to start using these products. They will also need to get the studios that Microsoft has, like Activision Blizzard and many more, to get the most popular games onto their Meta platform in order to be successful. I also think Apple will be a huge competitor in this space as well. But again, it'll be hard to judge until we really see what Apple's product is like and what they have to offer. But I'm sure it'll pose a huge threat to Meta because they already have a huge ecosystem in which people are deeply ingrained into. And if they can offer iCloud, Apple TV, Apple Music, their photo library, and many other of their services on their VR device, I think they'll have a really compelling offering that can give Meta a run for their money. It's also really important to note that Apple has 50% market share within the US consumer of people having their iPhones, but with teens and younger adults, it shoots up to around 87%, which is really important because most people that are buying and adopting these newer technologies like VR and AR devices are going to be the younger generations. And with so much of that younger generation already ingrained into Apple's ecosystem, it will be really hard to get them to switch out of that and go to something like Meta's platform with their future VR and AR devices. One of the major problems I see with Meta's platform is when they come out with their AR device being just a regular pair of glasses with certain overlays so you can send texts and consume content that way. If Apple comes out with something that's relatively equivalent, they're gonna have iMessage within their glasses, and it'll be proprietary to their devices only and not Meta's. So if people continue to use iMessage and shame people for having a green bubble, they're not gonna wanna get the Meta AR glasses, they're gonna wanna go to Apple. Now, with Meta at this valuation, if they are able to create the next platform in which developers and consumers want to put their time into and do work and video games all within their platform, then I'm sure Meta will be a great investment over the next decade. And Meta will most likely reach all-time highs and do very well for anyone who is holding the stock. But if these verticals of VR and AR devices become popular, then there will surely be plenty of competition to go around from the likes of Apple, Microsoft, Google, and probably many other companies will want to get in on it. And as a consumer, I really want as many companies to take part in this metaverse VR AR technology space as possible. That way I have the best options and the best prices because of all of this competition. But I believe that if you think the technology will be a big part of our future, but you don't think it'll be on Meta's platform, then buying someone like Apple, Microsoft, or Google could be a good alternative to take advantage of this new market. And to wrap up my thoughts on Meta, buying at this valuation seems kind of like a steal because they still have their huge advertising business on their platforms that have billions of users. But one of the major risks you need to be concerned with is whether or not they're going to be able to execute on their metaverse strategy. So for me personally, I am investing at these prices in Meta, but I'm not too sure if they will be the number 1, 2, or 3 player within the metaverse space. And even if they are, it'll take at least 5 to 10 years for this stuff to really come to fruition. So it's important to be patient and give time for these companies to execute on their vision. Now, with that being said, thank you for watching this video. And if you believe that I'm wrong about Meta or Google, please leave a comment below and I'd love to hear what you have to say. So please like and subscribe. And with that, I'll see you in the next one.